Hey guys, what's up? I'm Erin and welcome back to Erin Talks Money. Now, when it comes time to buy a house, one of the biggest considerations that most homeowners have is what type of mortgage should they get? And the most popular mortgages out there are the 15-year term and the 30-year term. By far, the most popular choice is the 30-year mortgage, with only 10% of homeowners selecting the 15-year mortgage. But just because it's the most popular choice, does that mean it's the best choice? Well, that's what we're gonna go over today. But before we throw some numbers into the mix, let's first look at some of the differences between a 15-year mortgage and a 30-year mortgage. First and foremost, a 15-year mortgage is going to come with a more favorable interest rate, aka a lower interest rate. You're less of a lending risk because you're paying your debts back quicker. So obviously that means a 30-year mortgage comes with a slightly higher interest rate. Now, if you are looking at mortgages today, you can find 15-year rates sitting at 2.5%, and you can find 30-year loans sitting at 3.1%. So common sense is going to tell us that you're going to pay far less in interest if you select the 15-year loan. One, because your interest rate is lower, and two, because your loan length is far less, literally half the time of a 30-year mortgage. So let's throw some numbers into the mix and see what this would look like over the course of the loan. The average home price in America is slightly over $225,000. So that's the price we're going to use for our home. And since it's not prudent to our consideration on interest, we're going to ignore any sort of down payment. So if you were to select a 15-year loan at a 2.5% current interest rate, over the course of that loan, you would pay $45,000 in interest. And on a 30-year fixed rate mortgage at 3.1%, over the course of that loan, you would pay $120,000 in interest. That's 2.5 times the amount of interest you end up paying simply by going with a 30-year mortgage. That means over the course of the loan, factoring in principal and interest, your $225,000 house actually costs you $270,000 with a 15-year mortgage, and it costs you a whopping $345,000 on a 30-year mortgage. At first glance, it seems like a no-brainer. Go with the 15-year mortgage, own your home quicker, spend drastically less. But if it's such a no-brainer, why do so many people go with the 30-year mortgage? Well, it honestly comes down to the monthly payments, and that's a huge consideration for many people when they buy a home. If we were to use the exact same interest rates and the exact same home price, that $225,000 home, if you were to choose a 15-year mortgage, your monthly payment would be $1,500. However, if you were to choose a 30-year mortgage, your monthly payment would only be $961 a month. With such a drastic difference in the monthly payments, it's not hard to see why so many people go with the 30-year mortgage. Coming up with an extra several $100s every single month is no easy feat, with already having 80% of Americans living paycheck to paycheck. Tackling a smaller monthly payment is just easier, and it allows many Americans to buy a bigger home than they otherwise could in a nicer neighborhood, likely with nicer schools for their kiddos, all for a lower cost today. That's the primary reason the vast majority of people go with a 30-year mortgage. Yes, it may cost more in the long run, but in the short term, on the month-to-month basis, they're actually spending less money. So they get to enjoy a nicer home and everything that goes along with that for a lower cost today. Well, if you were to look at those numbers and you're a financially driven person, you might be thinking that a 15-year mortgage is the only one that actually makes sense, at least from a money perspective. But what if I were to say that's not the full story? What if instead of just looking at the mortgage payment, you were looking at what you could be doing with this spare money? Because money always has an opportunity cost. That is to say, we could be doing something else with our money or putting our money to work elsewhere to create a brighter financial future. So what would happen if you went with that 30-year mortgage that came with that $961 monthly payment over the 15-year mortgage with that $1,500 monthly payment? But instead of inflating your lifestyle simply because you have extra or spare money in your budget, what would happen if you took that extra money and invested it? The difference between that 30-year and the 15-year mortgage is $539. What would happen if you invested it? Well, first we're going to assume that you buy your first home when you're about 30 years old. Why? Because that's the typical age that the average American buys their first home. So back to the numbers. Let's say you go with that 30-year mortgage, even if you can handle the 15-year mortgage as far as a monthly cost. So you're now paying $961 towards your mortgage, and you have a spare $539 that you can invest. That turns into investing $6,468 a year. So if you do that over the course of 30 years, you would generate a nest egg of about $856,000. At that point, your home would be paid off and you'd have a tidy sum to fall back on in retirement. But as we said in this example, you bought your home at 30, so that means your home would be paid off at 60. Well, let's say you're not planning on retiring at 60. Instead, you're planning on a more traditional retirement age of 65. So now you have an extra 5 years and you can decide how you want to invest or decide not to invest. So say you want to supercharge your savings. Your home is paid off and you can now take that full $1,500 a month or $18,000 a year and put it into your portfolio and supercharge your investments. If you did that for just those additional 5 years, by the time you retired at 65, you would have a nest egg of $1.4 million. However, let's say you decided to sit back in your 60s and you didn't want to supercharge your savings. Even without adding another cent to this portfolio, on its own, letting compound interest take over for those additional 5 years, letting it grow until you were 65, it would grow to $1.2 million. Now let's run the numbers for a 15-year mortgage. If you take out that 15-year mortgage, your monthly payment is going to be $1,500 a month. And now we're going to say that you don't have any spare money to put towards investments. So for those first 15 years, you're not investing anything. You're paying off your house. But good news is, 15 years later, you own your home free and clear and you can begin investing. So at the age of 45, you begin investing that same amount, that $1,500 a month or that $18,000 a year. What would that grow to by the time you are 60? The answer is $585,000. That's a nest egg of about $300,000 less than the person who did the 30-year mortgage. But again, just to be fair, let's say that you don't want to retire at 60 and you're just like the person who took the 30-year mortgage and you want to retire at 65. So you continue investing that $18,000 a year for those additional 5 years until you get to 65. What would your portfolio grow to? About $973,000. If you wanted to stop saving altogether at 60 and just let compounding interest take over and work its magic, your portfolio would still grow to about $860,000. So let's compare those final numbers, assuming that you continued investing in both situations up until the age of 65. If you went with the 30-year mortgage, you would generate a portfolio that's about $1.4 million. If you went with a 15-year mortgage, your portfolio would grow to about $970,000. Each month in both of these scenarios, you have the exact same outlay of cash. Every single month, $1,500 is going out. The only difference is how it's going out, whether it's going towards a house payment or whether it's going towards investments. But it's important to note that in each of these situations, you're buying a house of the same exact price and you're spending the exact same amount every single month. The only difference being that with the 15-year mortgage, 100% goes towards the mortgage payment in the beginning, and in the beginning with the 30-year mortgage, a portion goes to investments and a portion goes to the mortgage payment. So your nest egg grows to about $430,000 more if you went with the 30-year mortgage. Why is that? It's because time is your most powerful ally when it comes to compounding and growing your money. It is simply too hard to make up for a delayed start to investing. Even if you have the exact same outlays of cash in this situation, you still end up ahead if you start investing sooner. Your dollars invested at 20 are more powerful than your dollars invested at 30. Your dollars invested at 30 are more powerful than your dollars invested at 40. Investing sooner is better. Time is what matters most in the market. It is simply too hard to catch up later. Even if we look at the halfway point, that 15-year mark, that point where the person who took the 15-year mortgage is totally debt-free, no doubt a great feeling, and the person who took the 30-year mortgage still has 15 years left to go, 180 payments, and they still owe $138,000 on their home. But they've also been investing for 15 years at this point, and by diligently investing the difference between the 15 and the 30-year monthly payments, they've grown a portfolio of $210,000. meaning they have a positive net worth of $72,000. While that may not be outstanding, it's still better than our person who selected the 15-year mortgage, and yes, they're debt-free, but they also have a net worth of zero. Yes, the route of diligently investing the difference between a 15-year and a 30-year mortgage no doubt requires discipline, and you're probably not likely to be successful with this route unless you actually set it up as an automatic investment. But if you set it up as an automatic investment, you're golden. Yes, I get the lure of a 15-year mortgage. You save a bundle on interest, you build up equity in your home faster, and you own your home in half the time. However, if you are a diligent saver, going with the 30-year mortgage can actually allow you to build your net worth higher if you're willing to invest the difference. And you'd still own your home outright by the time you turn 60 or 65 and were ready to retire. It all comes down to your discipline levels. Can you commit to saving the difference between these two mortgages? If you can't, go with the 15-year, own your home quicker. But if you can commit to saving the difference between the two, go with the 30-year. You'll end up with a higher net worth. I always like to say I would rather you be pro-wealth than anti-debt. It helps you be a little more successful in life. Let me know your comments down below. I am anticipating a lot of different comments on this one. Not everyone has the same opinion on this subject, and that's totally fine. I'm always interested in what your thoughts are. I'm always replying to those comments. So I post new videos every Monday and Thursday. Please give this one a like on the way out. If you liked the content, consider subscribing if you're new. Also, if you know a friend who might get something out of these, please consider sharing. That's gonna do it for me today, guys. I hope you have a good one. I'll see you soon. Bye.